Welcome to the Investor Readiness Podcast, hosted by Eric Dobson and DeMario McIlwain.
Hello, and welcome to the Investor Readiness Podcast. I'm DeMario McIlwain.
Eric Dobson.
Hey, Eric. Investor readiness, we talk about this all the time, in private conversations with entrepreneurs and things, but really, what is the deal?
Well, I think the big thing, the big elephant in the room is that investment capital is a very limited resource. I spent about 10 years of my life as a fuzzy-haired scientist working for the government, and then decided I could no longer take the government yoke, and I decided to start a company, not really realizing what I was doing, and I was becoming an entrepreneur. Didn't even know what the word was at the time. And so I went through 3 different startups, one very successful, one total disaster, and one sort of successful. And at the end of this process, I remember thinking to myself, dear Lord, there has to be a better way to get capital to worthy entrepreneurs with great plans. So
Yeah.
I literally set off at that point. I got invited at the end of that process. I got invited to join a capital firm, and my thought was, this is my opportunity to figure out a better way to do this. So that's
you, you
literally what I've
know,
been working on for the last 13 years.
13 years, that's crazy that you're talking about being the entrepreneur and now kind of leading the investment firm. That's a sneaky way to do this situation, I think. That's that's great. In 13 years, that just, me being an entrepreneur myself, it begs me to ask the question, um, why do you think there's been such a problem in this little gap that we see here? The entrepreneurs, we're launching our businesses and then, we're thinking about capital, but it's always a ball dropping somewhere.
Yeah, well, I mean, I think the interesting thing is, when I jumped sides of the table, I really wanted to learn the private equity side. I mean, I understood the entrepreneur side and how to raise capital, but I wanted to understand from the investor's perspective what where was the disconnect? There seemed to be a
Yes.
disconnect in language. You'd think that entrepreneurs, I want capital, I want to give capital. Great, that seems like an easy conversation to have, but it's not. It's actually very, very difficult, and it's complicated by several things. One, it is a very rational industry overall, and it's very Darwinian. The best deals bubble to the top, but it's a melee between the bottom and the top, unfortunately. But I remember saying, even gosh, right before I jumped ship and really became, jumped in on the investor side, and I told someone, if you could convene the top 100 experts in this industry, you couldn't come up with a less efficient system for getting capital into great companies.
That's what I think
And
about.
a lot of that's just it's just a language barrier in many ways. That's kind of where I ended up with this, talking about this. Is It's not as hard as it sounds, but it's a language barrier that we got to break through.
Yeah, Eric, I talk about this a lot now, and the more and more I talk about it, it's one thing that I truly don't even understand completely myself, like from the investor side. It's like what you were saying earlier. You want to invest, and you are an investor. This is what you do.
Yeah.
I have a viable product, service, whatever the case may be. Seems like, long as it makes sense to you, you would be eager to put some money over here because I can, because we're all talking about predictable things. We don't know if it's actually going to scale, sell, and all of these things. So everybody's taking a risk. And so I always wondered, like, why is it so hard? It seems like it's just so hard because, like I say again, the investor, I feel like, me having a business and an investor being investors, that's the same type of scenario. I build things, the investor looks for things to put money into. So therefore, if we meet, we have a great conversation. My documents, what have you, makes a little bit of sense. That should be like a seamless process. I always say Shark Tank. Shark Tank. You
Yeah.
go, we look at Shark Tank, even though they say that half the deals that you see on there does not make it past a certain stage, or
Yeah.
that the investment, I mean, the pitches that we see on the show actually can be 2 and 3 hours long. We only seeing the meat and potatoes of it. But I always wonder, why is it so hard or seemingly
Yeah.
so hard?
And again, I think a lot of it's a language barrier. I mean, the entrepreneurs want to talk potential and pitch deck, and investors want to talk risk and pro forma. It's one of the things that I've said for a long time, and we've kind of developed a model we have at Community Equity Partners. We invest. On a good year, we're investing $3 to $5 million. On a bad year, we're investing $1 to $2 million a year. We're typically doing 5 to 8, maybe 10 new deals a year.
Wow.
We are, we'll do an equal number of investments in existing portfolio companies, helping them move along. And so, we've always got this broad perspective on it. When times are bad, like right now for capital, we're investing more in our existing portfolio, doubling down on them to make sure they get through. On good times,
Oh,
we're investing in broadly in new investments. And so there are a lot of, I guess what I'm trying to say is there are a lot of things on the begging side of this instead of the giving side of this. As I say that as a joke, it's more fun to give away capital than beg for it, I promise. But there are many things on the begging side versus the giving side that you just don't see.
yes. Yeah.
I mean, I remember thinking when I first, when I was raising capital myself, I thought this is obvious. Surely they can understand this. And I would get something back like, well, we don't like your valuation. I was like,
Mm.
okay, I understand that. I didn't think the valuation was that bad. I already had other investors that were investing at that valuation. And when I finally jumped ship, what I realized was what you hear and the reality often are two different things, because I don't like your valuation really means I don't think you have a big enough market to justify my investment at that valuation so I can get my return. And that's never
Yeah, that's
stated anywhere. So
yeah.
again, this is part of that language barrier.
But Eric, come on now. I'm thinking about the other people that are watching this, and I love our podcast because you actually come hardcore from the investor side. I'm diehard entrepreneur, so we get to bounce back things off of each other. So I'm thinking about, okay, my market size. Now, I might have done some research and gave you a number based on my research, but you actually being the investor with your due diligence probably could come back and tell me that it's actually a probably larger market than I thought it was.
Or
But
smaller.
yeah, or smaller, true. But so that's not something that investors do.
Yeah, I mean, absolutely. At the end of the day, this is a golden rule industry. He who has the gold makes the rules, he or she who had either one. But my point is, yeah, the interesting twist is, of course, that entrepreneurs are asking for investors to part with hard-earned capital. And that capital is working someplace already. It's doing something. It's not just sitting around, resting by the pool and waiting for someone to walk along and need it. It's working someplace. So what you're really competing with when you ask for capital is you're asking for an investor to take these resources out of some other project they've invested in
Mm.
and put it into you. And so that's why this is such a limited resource typically, especially the angel stage. When we talk about angel investing versus venture capital investing, angels invest their own money, and venture capital people invest other people's money. OPM, other people's money.
I
So
think that's a song.
it should be. We'll make one exactly. But if you think about it, it's a very limited resource. It's very competitive, and to get capital from an investor, any investor, you need your venture must be in the top few percent of all the deals in the marketplace at that time. This
Ooh.
is not an iterative process. You'd think this would be an iterative process where you could say, "Hey, I want to do this," and the investor could say, if you just do this, I'd be interested, but that's not the way it works, because what you'll see with savvy investors is they see too many deals. too many of them come flying past them, and the question is which ones do they grab onto, and so they're typically looking for ways to deselect deals, not select deals. So you really, this, nobody tells you this. I learned this the hard way myself. You really only get one shot with an investor, and so you don't waste it with an incomplete story or
Mm.
holes in your business plan or anything like that, because the first thing an investor is going to do is look for the top three reasons to tell you no in the first 15 minutes.
Uh,
So,
Thank you for clarifying that because, really, until you said they're taking money from another resource, another venture, what have you, put inside of this because this is their world. We don't look at it like that. At the end of the day, we look at it from you got a bank account with some money
right.
sitting in it, and you're gonna part with some of that money by writing a check. We don't know the mechanics behind the scenes and things of that nature. So it's always a why. This is a great deal. I talk to founders all the time, and you know, as I say, there's two sides to the story when the founders say, this is it. I'm the unicorn. I love that energy and that insight into because that's how you should feel about your business. But on the other side, from the in the investor perspective, it just not might not be the case. You might not be the unicorn because we don't see everything that the investor sees. So therefore, if you're getting a lot of submissions, we feel like in our own right that we are the star power. But you might look at it across your desk and say, yeah, it looks like this right here is lower caliber than this or that. Do you think the game works like that?
And to a certain extent, absolutely. But if you think about, I mean, the stats are pretty clear. 75 to 95% of high growth startups fail in 5 years. So the one thing we know going into this is there's a 75 to 90% chance you're going to fail and take all of our money with you.
That's
And
kind of scary,
so
man. That's
it is.
that's
It
that's
absolutely
scary.
is. Now, the smart investors, if you ever heard of a venture studio models where investors really add value to they live longer, 30% longer. They exit 30% better. I mean, it just if you go on and that's one other point I want to make here, and we're going to probably come back to it, but it's the catalytic nature, the catalytic effect of investors on a business. I know investors can be a roaring pain in your backside. I'm one of them. Capital always comes with strings attached. We talk about getting married, getting into bed together, that kind of thing. And the reality is, yes, we become part of your team. And especially, and we can talk about, Heartland versus Silicon Valley. There's all sorts of dichotomies we can talk about. But out here in the real world, investors like us, we have to invest time, both time and money into the company. We've money first, and then it's time where we can add value. Because if we don't add value to you, you're just struggling against the world. My point being that once an investor finds you worthy, it's easier to find more investors. And the more investors, especially if you're picking out smart moneyed investors, the more value they add to your business, the more you reduce risk, and the easier it is to tell your story and tell it well. So that's probably a
Yeah.
long, convoluted answer to your question, but
No, 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 no. Because I'm cheating here. I'm eardropping, because I have the opportunity to talk back and forth with you often, and
mhm.
some of these questions. I often tell the founders that I be talking with. I say, the beautiful thing is I get information firsthand that I can kind of tell the entrepreneur like, hey, you might not want to think about it this way. It's this way, and this is not DeMario's words. This is what I'm learning in this process as well. But it is something that you touched on earlier that I think I want to pose it to you as a question, but to the people that's listening, you was talking about the times right now. Being that we are dropping this right now, you and I was having a conversation maybe a couple of days ago, and you was telling me about the state of investment or investing right now. I want you to kind of give your insight on that because I think that is key because we still have founders out here creating, we're talking to them all the time, but they might not fully understand or take it personal if the interests don't seem there from the investors that they're reaching out to. Could
It's a great question because there's always, political, economic headwinds that the whole market battles with. I mean, right now, this has just been a strange, an economic, the period of economic weirdness this year because of the whiplash, economy stuff has put most of the investors on the sidelines. It's just reality.
Wow.
I'm not making any political statements about that. It just is what it is. Anytime you see uncertainty in our market, when the stock market's you know doing strange strange things, when you start to see consumer confidence start to drop, you start to see things like that. It just means that the capital markets, everybody goes to a safe harbor and waits for everything to happen, and then they come back. I would say the market is generally right now optimistic that the second half of 2025 is going to be what the first half of 25 was supposed to be. And it just didn't occur for several reasons. Um, so there are some headwinds we have to deal with. The other thing
Yeah.
is, obviously you've got, well, when capital's scarce, capital's always scarce. But great deals will always get done. If you've got a great deal, you can get money.
Mm,
The line for what gets funded, and, again, when capital is more readily available, more deals get funded, and that by definition means, and I don't like to use the word quality because it's not necessarily a quality score; it's a maturity score. Less mature companies get invested. Uh, Poor quality deals never get invested. It's really, when you think about entrepreneurship, and we learned this when I was working with a popular software company in our industry trying to build some diligence tools, and we kept looking at scoring systems and trying to figure out how to match up the very best, seed stage company with the very best Series A company. What is it? How do we come up with this? We're trying to do a quality scoring system, and we couldn't make it work because there's no way to compare a seed stage company that's knocking it out of the park with a Series A company that's floundering. Okay, they're just different
yes.
beasts. And so what we figured out is it's really a maturity score. And within certain windows, you might be able to say this one's slightly better than this one or slightly more mature. But at the end of the day, it's really, because that's how investors think about these things. It's not necessarily quality because no one invests in poor quality deals. It's about maturity. Do I like to invest in seed stage companies or growth stage companies or later stage scaling companies? That's really a maturity factor. So,
When you were talking, I immediately started thinking about shows like American Idol. And I'm going to tie this together because I know people saying, "What? American Idol?" I always tell my wife that, when you're listening to singers on American Idol, some singers to me sound great, some don't. And then, vice versa to who's ever listening. And I say, as a judge, how do you determine one person's talents against another person's talent based on singing? Because this person sounds like this person has a totally different sound, but in their own right, they are a great singer. So now you put them all on one stage to come up with one. So how I relate that to the investment side, how do you relate? You have this startup business, they're new and they got this vibrant idea. Then you have this business that might not be, I'll say, as technical as this business here, but they've been rocking and rolling for about 2 years or so. Both of them are on your table. You got one check to write. How do you decide which pathway to go? Which probably leads right into our scenario here, how investors view startups. But I always wondered that, if I have a business and maybe I'm just beginning to make revenue, but I got some bad stuff inside of it, man. I got AIs that basically come out and shake hands with you. But this business here is 2 years. They're cash flow positive. They making a lot of revenue. We both land on your desk at the same time. You got one check. How do you determine who wins the
yeah,
prize?
There's several ways to look at that. One of them is just traction, commercial traction. Who's closer to revenue? Who's got, who's got the better marketing and sales plan? Um, who's got the better network access? There's a lot of variables that go into
So
that.
you're going
We
line.
start,
So you're basically going
yeah,
line by line items by line items in
yeah, and we start
comparison.
getting right down to it. We've got we look at 16 different. We actually do diligence on a company. We look at 16 different variables, and we actually score all 16 of those variables, and we'll from 0 to 5. Obviously, 5 being best, 1 being worst, and 0 being not applicable. But at the end of the day, those scores help us. But it, and I hate to sound flippant about it, but to a certain extent, it is a beauty contest.
Mm.
Who's got the sexier deal? Who's got the bigger market? Who's got the more mature business plan? I mean, there are a lot of factors that go in. I'd love to say it's one thing. And by the way, if you have to boil it down to it, and everybody will tell you this, if you really boil it down to one thing, it's who's got the better team. Who's got the
Wow.
who's got the
Wow.
better team, the more experienced team, again, 50% of success is going to be based on the team and their ability to innovate and adapt. Um, Certainly, and you'll see some literature says up to 40% of success is just timing. I don't know that it's that. I know that's a significant issue. So best team with best timing is, in theory, would be about 90% of success.
That that's crazy because you're talking about teams. And by the way, everyone, we talk about having a great team inside of the Investor Readiness Program. There's probably going to be a link down below that you can go check that out with. But we always talk about hiring A players and not B players because you just heard it here. If it really comes down to company A or B and one team sucks and the other team knocks it out the park, then hey, it puts you in a better position to gain that investor's interest. That's what I just heard. I don't know what everybody else heard, but I think that is key there. But also with that, you were talking about earlier about how you become a part of the team, as the investor. So therefore, once you lift the hood of the car, you are inside of the day-to-day works. Is there sometimes that investors get into a deal and kind of wish they want to pull out once they get deep
Yeah,
into the hood, sitting on the board and things of that nature?
yeah. If you do diligence correctly, the answer is no. If you don't do diligence correctly, the answer is yes. Startup companies don't fail for lack of capital. Everybody says, "What'd you fail?" Oh, we ran out of money. No, you ran out of planning.
Oh,
Uh,
wait a minute here
yeah,
now, because you just hit on you hit on something there. I had always believed that the startups fail because they ran out of money. So
that's a
what you
false
were saying
narrative.
to me is that it's not the money, it's the planning.
Yeah, it absolutely is. And we can talk about the Silicon Valley versus, you know, Knoxville, Tennessee, or Charlotte, North Carolina, or wherever. I mean, there are different rules, and there are different rules for different places. This model doesn't work. We can talk. We got a whole show. We can talk about that. But yes, my opinion is, after looking at all this, and there's literature, there's articles about the top 10 reasons things fail. They fail for bad founder chemistry. That's number one. Occasionally, it can be, I've seen a company fail because they got scooped on a patent. So that's just unfortunate. Someone else stole their plan before, unknowingly scooped their plan before they got to market. That's to a certain extent bad timing. But for the most part, it's just bad. It's just lack of planning. You've got, if you have to have capital to get to this milestone by this period of time to meet the timing of the market, you plan backwards, and if you can't make that work, you shouldn't proceed. Okay, that's one of the challenges here. This is not. It's not a. You're not a pinball in a machine. There's no random thing where you're going to fall into the hole and get 1,000 points. It's just this happens by concerted effort, focused activity, and ruthless. ruthless customer discovery. If
But
your customers will tell you how to be successful if you'll do enough research and planning, and just listen.
I really like how you made that punch feel a little bit softer in your tone when you're basically saying is that if I have a business and I'm looking at what I need to get to even making more revenue, in between that I put a dollar sign. Maybe that's $1 million. So I'm saying, hey, when I raise $1 million, I can go here. And if my whole idea in business is based on me raising that $1 million, I'm probably going to fail.
Yeah.
Hey, well, on here we
Or
want.
pivot early. I mean, the bottom line is, you're listening to your customers. You may find a cheaper business model that you may be able to get there on $500,000, but you got to change your business model to make it work. Again, it's about, there's no such thing as perfect information. You're never going to get perfect information. And the joke in the industry is, of course, everyone will lie to you until you ask them for money. Everybody will tell you, that's a great idea. Then you say, good, give me money. Then they go, well, this is the problem. And so, actually, the joke goes on to say, even your mother will lie to you.
Yeah, I was just thinking the same thing. That's crazy because E- I don't know. A lot of things are going through my mind right now. It's just because the mindset, when you were talking about earlier, is our mindset between the entrepreneur and the investor. I was not thinking this way. I can be honest and say, as an entrepreneur, I build and I build, and then you get to that point to where you want to raise capital, you want that OPM, um, and you just simply think about it from the aspect of I got this, I can show proof of this, and you can write me a check. You have the ability, this is what you do. You write me a check and we keep it moving. I don't think about the planning part. I don't think about even from the customer standpoint. A lot of times when people are really down in the weeds, and you know this, Eric, especially in the tech world, they spend most of their time coding to the best product ever. They're not thinking about customers. They just feel like once they get the money, money can buy anything. If I have $1 million in the bank, I can buy me enough ad campaigns to get customers. I'm not thinking about that before I come to your table.
That's where the word pivot comes from. Okay.
Yes.
'Cause that means you didn't ask enough questions of your target audience to understand what they really need. Yeah.
Wow, wow. And that's a lot of researching. And
It is.
Eric, I think too, from the entrepreneur side, I think there's not a lot of researching that goes into play. I'm just thinking about my own actions, and I'm using myself as a guinea pig here. I'm saying like, you know, I have launched businesses before just based off of the gut reaction of, oh, this is great. Let me put it out there. Then you might get some ones and twosies that comes in there and buys the product or the service, and then it fades out or whatever the case may be. But I never put too much pre-planning into what that looks like. And I think now that I'm thinking to myself, I'm like, that's probably why it didn't move fast like I thought it was. Because I'm only looking from my own eyes. I'm not thinking about the customers. One thing that I know we have talked about before, even the pain pill versus a vitamin scenario. It's a lot of vitamins out there right now. Oh, it's a lot of vitamins.
Yeah. The other way of saying that's must have and nice to have. Exactly.
Yes, especially in the AI
One,
world.
yeah, one of the things I found, both as an entrepreneur and definitely when I go out and try to help our startups, um, companies have a top 10 list of things they're going to spend money on. Only the top three get money.
Mm.
So even if they say, yeah, that's in our top 10 list, unless you're the top three, and those top three, I mean, bear in mind, and I'm sure we'll say this many times throughout this process, companies buy products and services for very simple reasons. It makes them money, it saves them money, it can make them more efficient. That goes to saving money and making money too. The other one is satisfying regulatory requirements. That's it. Those are the only, I'm sorry, brand and brand escalation, brand protection. Those are the only reasons that a company buys anything, protect a brand, make money, save money, or satisfy regulatory requirements. That's it. So when you
Wow.
make a pitch to a client, you're not pitching a piece of software. You're pitching brand protection, make money, save money, or satisfy regulatory. That's what you're really pitching. And that's where I get back to this whole concept of a language barrier, two people separated by a mutual language. You're not selling software. You're
Mm.
selling efficiency or selling the ability to make more. You're selling revenue or selling efficiency or compliance or brand protection. That's what you're selling.
But Eric, I just need a check to I need to hire this bad team, man. I need to hire this team and I need to get this big building because I foresee if I can get money to get 20 people on my team and get this big building, this is going to be a viable business. And you should be excited about that.
Sure. You got to prove it to me. Well, here's the other thing that's really, really,
I like the
really, really,
hesitation there. I like that was good.
yeah. The other really important point here is that when you're talking to an investor, it's a trust building relationship activity, don't get me wrong, but it's a marketing and sales job. If you can't
Hmm.
sell me, basically shares of your company, you probably can't sell products and services to a client either. So this is the first time as an investor, first time I get to see how you, Mr. Entrepreneur, market yourself, market your company and sell. And again, if you can't sell me something, what makes you think you can sell anybody else anything? And I think there's a lot of that's lost in the conversation. It's a marketing and sales job.
You know what? I know that's your stance because when we first met in October 2024,
Yeah, been a while.
that's was the one thing that you said that stood out to me. And here we are, you're still saying the same thing. So I know it must be tried and true.
It bears repeating.
But like I say, with the people that's watching, we have to just kind of lay it out for them. You was talking about the 5 points or the 15 points or whatever, the criteria that you look at in due diligence. And I don't know if that is that public information from investors in general. Do they share, like their steps or is that something that they don't want you to know exactly what they're
Yeah,
looking at because you might cheat?
most don't, and most don't share their results anyway. I mean, when I was looking for a better way to make this all happen when I took the job back in 2012. But one of the things that I said back then was I'm actually going to tell companies why we're saying no. And everybody around me said, "Oh, oh, oh, no, God, no, no, you can't do that. That's going to be a disaster." And it was exactly the opposite. 95% of the companies I talked to, by that I mean turned down, um, usually they gush with thanks for actionable feedback because
Yeah.
that most investors you'll get this doesn't fit our investment strategy right now or something like that, some kind of blah boring
Yeah. What is
unfiltered
that?
boilerplate.
Yes.
Well, they're afraid, and the problem is there's probably 5 out of 100 that get incensed that you don't understand their genius, and they get very defensive, and I've had to literally block phone and email block entrepreneurs because they got so angry that I didn't see their genius and understand what they were trying to do. And my response is, I don't think you understand. This is a sales and marketing
Wow.
activity, and you have blown it. So I don't care how successful you're going to be. I wouldn't sign on to your business anyway you're not someone I want to do business with. Anyway,
That's so
but
crazy. That's so crazy. You just made my heart beat a little bit faster when you think about entrepreneurs getting mad because this is their baby and they already
yeah,
foreseeing that they're going to be riding in a Rolls Royce in the next couple of years, and you, my friend, are stopping me from that. How
oh,
dare you? But you know, a lot of things that I tell founders that I'm speaking with, I say, there's a lot of investment agencies, firms out there, angel investors, VCs. There's tons.
Mhm.
You cannot just base all of your hopes and dreams on one entity. You
No,
know,
no, you cannot.
so you know,
It's a
it's
numbers game.
like
It is a numbers game. Yeah.
yes, yes.
But but take a rifle shot approach, not a shotgun
Oh
approach.
yes, yes, most definitely, most definitely. I know it
You're
was a
just wasting
guy.
your time going after the wrong investor at the wrong time with the wrong pitch.
It was a guy I followed. I won't put his name on blast, but I was impressed when I first read his story because he had did 150 investor pitches. He finally got one.
It's
Eh,
about 15 to 1 to get an investment over time. It averages about 15 to 1, 15 pitches to one successful.
Wow, so you mean to tell me I can't have a one-to-one scenario?
Nope.
Oh man.
Nope. Nope. Nope.
That watch this. We should have that music on that on the game shows when they pick the wrong
Wah,
answer.
wah, wah.
Yeah, because I'm pretty sure people like Eric. If I just get a hold of you and show you my idea, then voila, magic is
Well,
going to happen.
I will say there's a great strategy. I used this back when I was an entrepreneur raising capital. I would find some, investors at the next level, go to a conference, whatever, and I'd stalk them, find them in a corner, grab them, and I would say, "Hey, listen, I know I'm not ready for you yet, but I want to come back in 6 months. Here's what I'm doing now. Here's what I'm doing the next 6 months. And when I come back in 6 months, I want you to take me seriously, take my call."
That's
And
building a relationship, though.
exactly. So relationship building is an excellent activity with investors. Again, but be realistic. And you don't have to, just say, "I'm going to change the world by doing this. I'm not ready for you yet, but in 6 months I'm going to be, and I want you to take the call." And that kind of relationship, especially if you show up and you've actually done what you said you were going to do, is a very powerful and moving thing. Because if you're a fan of Simon Sinek, you'll pretty quickly realize that if you look at his book, Start with a Why, you'll figure out that all investment decisions are initially made emotionally, and then we use data to justify our position.
Oh, 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 oh. Yes, no, like and trust, and then some data.
Yeah.
That's what I
Yeah.
heard.
So if you go read that book, and I highly recommend it. It changed my life, changed my whole concept of marketing and sales. You want to appeal first on an emotional level, but then have all the information that allows the investor to justify a yes.
Ooh, that's good. That's good. You know, if I wasn't here as your friend, I would be writing that down and hitting that submit button on the back of the CEP site. But but yes. So it really once again it kind of takes me back up to the top. Um how investors view startups. Just really, that is probably the number one question that I get asked. They say, DeMario, y'all know I'm not an investor. You know, my association with the RP and Eric, that's about as far as I can take you. Once you knock on Eric's door and you walk in, I'd be like, great, my job is done. But at the same time, I try to give guidance based on our course, because I know that course in and out, based on things I know you have talked about previously, or what I've seen other entrepreneurs failed at. So when I talk about how they view your startup, I'm now probably the most gatekeeping person. I'm gonna put it out there. Yes, y'all, I'm looking at you in your face. Yeah, I gatekeep sometimes because I'll look at it and I'll say, "Nah, I'm not even passing this on to Eric. Come on, y'all. I'm not passing this on simply because it doesn't even make sense to me. This is jibber jabber, and you're asking for $2 million, and I have no clue. Because the way I look at it, Eric, is that you know how I do. I'll hit you up and I'll be like, hey, I met this person and blah 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 blah. But if I can't explain what they do to you in just that little couple of seconds that I shoot you something, in my mind, that's a red flag. Even if I still pass it on, it's a red flag because I should be able to tell you a little bit about it just from glancing over it. So, but from your eyes, when you receive something, I know you was talking about you look for those, or investors, not necessarily you, but you look for those counting you out measures. You know, I see these couple of things and next. But how do you really view startups? Because, and before you even go into that, let's define for the record, what is a startup?
That's a great question. And it does mean different things to different people. But
Yes.
essentially, when we say we usually, the conversation usually degrades pretty quickly into seed growth or scaling stage companies. We think of the quote unquote startup as really that working in the garage, the
Yes, exactly.
fundamental creation step, the ideation step where you're creating the initial value, often great value. Uh, some people break that down, but to me, a startup is truly a seed stage company. We invest at what we think of as the startup stage. We primarily start, and I'll be perfectly blunt. We like to grab hold of when they're young before they develop bad habits because there are a lot of mistakes that are easy for startups to make that they don't even know they've basically nailed 1 foot to the track at the starting line because they did something stupid. And it's just
Wow.
because and you'll find this too. There's a lot of information about startups out there, but there's very few good voices that tell people
Mm.
what to do and what not to do. And that's one of the reasons that we have this investor readiness program. That's one reason I created the original material specifically because of this. So, but I think of startups as a true seed stage company. Once they start to gain real commercial traction, we may call that a Series A company or something like that, or growth stage company. So to me, that's the next category, where you've crossed the revenue line, you've got assets, you've got team members, you've got the trappings of a real business. Um, if you look at startups, to me, the challenge, and I haven't done this, but I believe I can mathematically prove that a startup can never gather enough resources to run itself correctly. So what that
Mm.
means is you've got to run yourself wrong the best way you can, and that's part of your story as a startup is why do you deserve more resources? And part of that is good stewardship of what you've already had, strong ideation, strong team alignment, things like this. There's all sorts of things that many of them intangible that say, I am a startup, but I can transcend to growth and scaling because of my attitude, because of my understanding of this process. Just there's a variety of things in there.
You know what, Eric? You know my first love is AI.
Hmm.
Um, in the world of AI, what they're saying is that hey, soon we will have one man corporations
Hmm?
with a whole bunch of AI automations. Now that kind of plays on to your model of saying the great team. Now my team is the Susie bot and the Jesse bot and excuse me, all the other bots that I got in automation. And we're producing, we got results. How would you view that one?
It's a great question. My opinion is that AI makes people more efficient. It doesn't necessarily replace people, especially for creative positions where you have to necessarily be creating and ideating. It's a great sounding board, and
Mm-hmm.
once you decide on a path forward, you can automate a lot of those things. I mean, I'm building automation tools for our diligence pipeline right now and I'm
Wow.
and so it's it is an incredible efficiency tool. I still don't see it yet as a fundamentally creative tool. I don't see I think you could probably say, hey, I've got a great idea to ChatGPT and I'd like you to create a business plan around this, and it'll do it. But
Mhm.
it tends to lack the passion, the grit of a true entrepreneur. And ultimately,
Mm-hmm.
we're still, even if you can have an incredibly efficient company, and you're right, you can have, we can now reduce the number of people it requires. You've still got to have a broad enough and diverse enough thought matrix across product, executive, capital, marketing, sales, production. There's not a single person that can do all that themselves. And that to me is the limiting factor of saying we could have a single human with a bunch of agents and be a dramatically successful company. Perhaps with a very narrow SaaS-based business, you could pull that off.
You know, you got some tech guy out there right now who's been coding since last year. He's pulling his hair out. What do you mean? What do you mean? Because I know I can create this. I have a whole corporation. Because I believe I read an article. It's coming out of China, and they were talking about. I don't forgot the guy's name, and someone probably can Google it. But this guy, he made into the millions
Yeah.
just as off of himself and AI bots. And this was even before the AI automation was on the front street like it is now. And I even looked at it and said, you know what? Is that actually possible? Can you, if you have a person in admin, okay, you replace all of the admin duties, answering the emails, phone calls, blah, 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 with some type of automation because you got voice, you got voice chats and things now. The production staff, especially if it's a SaaS company, all of these things, and you as the CEO, you just make sure all of these buckets are running seamlessly, and now you're making money. But to your point, yeah, there still needs to be some human touch points in there, or human interaction in order to have a vibrant business, per
Mhm.
se. Point, because I'm
Yeah.
actually daydreaming as I'm thinking that, because I love AI, and
Yeah,
I
me too.
I envision right now. I would literally have, if you watch the Jetsons, I would literally have Rosie sitting somewhere around me. Rosie was the robot back in the day. I would have a Rosie. I'm
Meet
telling
George Jetson.
you. Yes, I'm gonna. When they make it available at Lowe's or Home Depot, I'm probably gonna be the first one to get one. Just
Well,
it
yeah,
might freak me out, but I'm gonna do
yeah.
it.
Well, and there's a couple things with AI. One, I actually 1991 was the first time I worked with a piece of software on a with an artificial neural network. I was back in grad school, and I remember seeing the construct of truly artificially intelligent and how they were basing computers, basically computer structures on the human brain, all this kind of fun stuff. Made sense to me. I actually did a project in 1993 with an artificial neural network modeling climate change, which was fascinating back then. And that was before, that was interesting thing is that was the early days of the greenhouse effect. People were still debating that scientifically. So I did some work on that. But since then, we went through this machine learning phase. We've gone through several, and now we're to a truly remarkable period. I've never seen a technology soak into society so quickly. I'm not sure. I think it is absolutely, to me, unprecedented. But the challenge with AI is there are companies that require AI to do something, and they have a specific business model. There are companies that can use AI to automate or accelerate. Those aren't the ones that are necessarily going to get invested, because once you step away from, if I need AI to accomplish something fundamentally new, I've got a value proposition in that space. Otherwise, it's a marketing and sales company, and all you're doing is automating that process. So we have,
Mm.
from an investment standpoint, we look at these things and ask the question, is it AI native, or is it AI nascent? How that's really that's a big question, because you can have a one man AI nascent business. I think one man doesn't matter, fairly quickly, but to do something truly revolutionary in the AI space, it's going to take more than one person.
Ooh, that's great. That's great. So that really kind of brings into a point with the investment landscape right now with everything. And I was just having this conversation with a founder the other day. Um, Everything right now has an AI tag to it. if you add a chat bot, it's AI.
It's a
You
buzzword.
know, but would you say that the investment, just overall the investor community, are they leaning more into the AI phase and the even going further? I know quantum computing is coming up right behind that scenario. Or when they think about smart money, are we looking at more of we need to be as entrepreneurs need to have a more technical business that kind of matches where the world is going, within AI and all of these things. Would that be considered smart money investment? Because, when you're looking at the exit strategy, you're talking about, I think y'all say 5 to 10 years. Um,
Yeah,
so
10 would be a long horizon for us. Three to five is the target. Seven's sort of acceptable.
and we'll have to do a whole nother segment on the emotional impact of telling people that, hey, you can get my money, but we're looking for you to sell something in the business in 3 to 5 years. That's a totally different subject. But anyway, but so therefore, in the way I feel about technology, in the next 5 years, if we think we high tech now, 5 years from now,
No.
we're going to really see something. So therefore, if you're looking to exit in 5 years, you're going to exit in a time frame where technology is going to be higher than it is today. I'm not going to say it's at its peak, but your business model today might not even be worth selling 5 years from now based on how we're moving. Is that your thought?
Well, the tech we'll see in 5 years will completely obsolete the tech we have today. At the pace we're going, I don't think that's a question mark. I don't think it's a question at all. What I will say is that's where the fundamentals of business come in because business models won't change. Tech models will change dramatically. That's why business plans are still critical, and business value propositions, understanding those and being able to communicate those in a sentence or two, is still critical. Uh, and the ability, yeah, that's tech is going to constantly change under business, but the business itself, I don't believe will change as long as we're selling to humans. Business isn't going to change.
Watch this. I seen those wheels turning in the back of your head when you really thought about that, because I can get in trouble for saying this. You were just talking about earlier, the 75% of businesses fail, in the amount of certain years. I'm thinking about certain business models of today. And you're seeking investment today with the onset of saying, hey, we're looking to exit 3 to 5 years. Your business today, I still think in 5 years might not even, because in order to exit, you got to have somebody that's willing to buy it.
Sure.
So in 5 years, that it might lessen the scenario.
Well, what has happened is AI has lowered the bar to create a company. It's also lowered the bar to compete with a company because
Mm.
now you've got a predicate sitting there in the marketplace, and you basically say, take some agents and go knock that off. Why in the world would I buy that company? You're going to buy them for
Oh,
their client base. You're going to buy them for their commercial traction. Again, that's why I say business isn't changing, but the tech is.
I got you. I didn't look at it like that. That is crazy. That's a whole nother conversation. Yes, they can knock you off faster
Yeah.
and be more proficient. Oh wow,
Yeah.
that's a whole nother conversation, man.
And
That's
if they've
that.
got a war chest to do it, good luck. What are you going to do? Sue them? Yeah. That's what, again, there's a whole conversation about how to create intellectual property on the AI side. And can you create intellectual property on the AI side? So there's some fundamental shifts going right now. What it ultimately means at the end of the day is that we're more and more and more moving to, I don't want to use the word business model, but it's going to basically we're going to have more and more marketing and sales companies, and by that I mean the company isn't producing anything; it's just purely a marketing and sales vehicle for something, either a software or whatever is going. But it means the focus is going to have to go on more proficient uh, marketing and sales, because again, you're going to get bought in the future for your client base, not your technology.
We had an intentional pause right there, right after that statement, because that really just hit me. Yeah.
Yeah.
So therefore, going back to working on your business and not building, not bringing in your clients and building up, your brand awareness and things of that nature, that is going to be your most valuable asset in a couple of years.
Yeah,
Um,
absolutely.
because your business model, just as the business itself, just the core business, yes, it could be knocked off or it could be disrupted. It could be a whole bunch of different things, but your clientele, the people that's inside of your wheelhouse,
Your
that
trademarks.
that was a negative. I hope somebody wrote that down, because I mentally just captured that. So we've been talking pretty great, and of course we could go on and on, but we don't want to even spoil y'all like that. So I just because I get to ask the question directly, and
Mhm.
no, it's not an interview. Me and Eric already discussed. We having a conversation, but I can't help but ask questions because I can hear all of y'all's voices in my head saying, "But DeMario," and they know I'm gatekeeping, so that's I'm gonna put a shirt say gatekeeper. But before we got to drop this, Eric. Before anything, you have to check out the Investor Readiness Program. GetInvestorReady.com. You have to go there. That information is the bomb. The reason I say that, Eric created it. You don't believe the fact that on the IRP side, the GetInvestorReadiness.com, that is just a snippet of what you could have been going through. So thank me later, that you wasn't going through that full 15, 20 hours worth of stuff to get to Eric and he tell you you still got more work to do. We itemized it down to get you on the right path. I'm saying thank me later, because I've seen it all, and I knew right then and there y'all would be worn out trying to take that information. I understand, I get it. But so Eric, if you had to just itemize the things and say, to kind of align with our topic today, how investors view startups, what would be those things that you want to leave our great audience with?
Yeah, that's a good question. I mean, we entrepreneurs are the bedrock of our economy. If you look at any of the Bureau of Labor statistics, somewhere between 80 and 90% of all new job growth is in small companies. So our
Yes.
way of life depends, our very, very way of life depends on entrepreneurs doing amazing stuff. To those entrepreneurs, I would say, if you can't bootstrap, then you have to add, if you're going to have to you're gonna have to get capital someplace. That's either a bank, which is unlikely, or investors, which
Hmm.
is, they come in many shapes and sizes. So do your homework before you engage, before you make first contact, because this is a full contact sport, and it moves fast and furious. So, if you can't look at yourself in the mirror and say, this is a top 5% idea, think twice about it, because you're going to spend a lot of time and a lot of money and a lot of effort, and it may be fruitless. On the flip side, if you truly believe you have something that can be important, uh, then do your homework, get involved in the process. It's fun, it's interesting. You're going to meet some of the best people you've ever met on the planet. And again, don't discount the catalyzing effect, the catalytic effect of investors on a business. First of all, you asked earlier, what happens when you find you get into a business and it's not what you thought it was. You shouldn't ever be there. You should have done all this in diligence. And I can tell you, when we do diligence, it's 40 to 60 hours worth of work researching a company and the team. And 9 times out of 10, we find something major we have to have the company go back and fix. Hey, listen, you made this mistake. It's easy to make. Go fix it. So that in and of itself, just having investors help vet your company is an incredible service. And the other thing you'll find is that, you know, The reason to do diligence is to convince yourself, for us, that other people would invest in this company. And
That's
again,
great.
so now that we've convinced ourselves that other people would invest in this company, we can invest and we can bring them in. Okay. Then we reach out to them and say, now come on into the fold. You said Shark Tank earlier. Shark Tank really doesn't exist in the real world. It's a very
Yes.
collaborative activity, and most people really want to share risk and share the lift because we love the process. We love working with great people doing great things with great plans.
That I loved all of that. And when you said that, that reminded me, and I would be doing a disservice to a couple of the people that reached out to me personally that completed the IRP. Congratulations to those.
Hmm.
Um, as you know, we have a great review process, like Eric was saying. You complete the program, we actually get the review notes back. I did say review. I didn't say the investment. I said the review notes. And if you anything like me, you have sent out stuff to investors before and you don't get any word. They don't acknowledge that you even sent the email. So this is a beautiful program. But the one question I get asked is, what is the process? And I believe we have talked about it before, but since we're going to have some fresh blood watching this podcast right here, your internal process. So I know, let's say all things check out and now you're starting to think, is this something that we want to be a part of? I'm gonna kick it off by saying, I know there's a thing called the soft call.
Hmm.
Could you kind of take it from there?
We did that on we did that on purpose to cut down on our workload. Long story short, it's very easy for investors to say, "I like this deal and I want to move it forward." The challenge, as I said earlier, everybody will lie to you till you ask them for money. We found ourselves in the early years when I took over this business. We were so overwhelmed with doing all these diligence reports and everything on these companies, and we weren't investing in all of them. In fact, it was like maybe 50%. So we were just way overworking to get to the 50% that people really wanted to invest in. So yeah, we started a process. It's a multi-stage vetting process, from a screening process to a pitching process, and then we go to what's called a soft deal call, and we ask all of our investors to commit, all things being equal and a diligence report in place, how much money would you put in this company? And they give us a notional number. They actually have to physically put it into our software management system. And if we reach 50,000 in notional commitments and soft commitments, then we go ahead and do the diligence. But we found that if we couldn't get $50,000 in interest before doing diligence, we weren't going to find it on the other side. And so even we act very in a very Darwinian sense. We act as our own entrepreneurs inside our own organization. We shepherd these teams through, but again, it's a bit of a beauty contest. Now, the good news is once you finish up the soft deal call, we go into full diligence. And I can't remember the last company that we completed a soft deal call and a diligence report on that didn't get funded.
See, there it is. I no longer will have to answer this question again. I'm just going to clip this part of the video and just shoot it to you because, you know, I always say I don't know what goes on behind the door. There's a whole other world there.
Mhm.
And I do know one thing. If you're looking for money today, starting fundraising today is probably not going to be your answer. I do know that part.
It's a bad time this year. Yeah. And summer's
Yes.
usually a little into summer is kind of a weak period traditionally anyway. But again, the industry seems pretty optimistic right now that come September, October, we're going to start to see some of the stuff we should have seen in January, February. We'll see. I hope so.
Yeah. But I was also alluding to the fact that if you are running out of money today and you decide to fundraise, you're not going to get a check next week. This is a
No.
process.
If you aren't in the market by August, you probably aren't getting money until January.
Great point. So don't ask me what the turnaround time is. I know the
It's
checkbook
three
is
three to
not
six
readily.
months on a round of capital typically for most people. We can usually get done in 2 months if we want, but it's usually a 3-month process from first contact to check. And it can be as long as 6 months. Yeah.
Yeah, see, now those questions I answer, I feel very relieved because that is one of the questions.
And we move
And you,
quickly, by the way.
what's that again? I'm sorry.
And we move very quickly, by the way. 2 months is
Yeah.
unheard of on our for us.
Yeah, and I have this passion. I want to see people win, and we'll have to talk again. We have to put this on our schedule to talk about the impacts, because I don't know, probably from your world, it's not a emotional no,
Correct.
but that no carries some serious weight on some
Yep.
people.
Oftentimes, we try as much as possible to say no, but if you fix these problems, feel free to come back. Most don't.
Yeah, well, I can imagine, man. They probably, well, you already said you had to block some people and everything. I'm pretty sure they tearing up the office. Some computer screens are now on the floor because they got that email. It's crazy. I'm gonna have to put one of them
Yeah.
old videos up that people
That is the one part of
tearing
my
up.
job that sucks, and it sucks hard, is having to send off a lot of rejections. We say no more than we say yes, by a by a
Yeah,
by a large margin.
that's
And
hey,
but that's also why we make sure we provide actionable feedback. And our process, the good news is the way we march through screening and soft call and everything, we collect all that information. And so when we give a company a rejection, well, they get one of two things. They either get a list of questions. Hey, this is what came out. We need you to tell us. We need to confirm these things, whatever. But when we say no, it's a list of 8 or 9 things that came directly from our investors, usually obviously reworded. So, you want to protect the identities of these people, because otherwise we wouldn't have honesty in the process.
yes.
So, but you'll get a list of 8 to 9 things that reasons that people turn down the deal, and you can address them as you see fit.
I didn't know that. I didn't know that part. That's cool. So all is not lost. That
No,
that's you know what? That's actually powerful in itself. To me, that's
I hope
powerful
so.
in itself. When you're doing anything, buying a house, buying a car, and if you don't get approved, you should ask the why question. Because the why question gives you the ability to go back and fix the things
Always
to
ask
to
why.
go and apply for that house or that car again.
Mm.
And I don't know why people walk out with the head. I used to be in the digital side of car dealerships, which is called the BDC now. But before it was BDC, they just had some guys that was good on the internet with Facebook and eBay, and they had us back there working. And I seen so many people just walk away after they say you didn't get approved. They just walk away mad. I was like, but you're never going to get approved. You don't even have the documents or the information on why the
Right.
bank said you're going to live with that 425 credit score for the rest of your life because you never asked why. But that's a whole nother subject. But my friend, it's been great doing this with you. I'm looking forward to our next one. Hey, at the end of the day, everybody, you got to like and subscribe if you don't want to miss it. And plus, you got to let us know if this information that you want to hear, because
Yep.
we don't
Send
want
in
to be
questions.
talking. Yeah, we don't want to be talking to dead ears. I'm the wild guy. You can see Eric is the serious guy. We're gonna keep that going on because I can't change. I'm too old now. So at the end of the day, we
You're set in my
haven't.
ways.
Yes, sir. Well, my friend, hey, until next time, brother. Hey, let's send everybody to IRP and let's keep it moving. We hope to see y'all again.
Sounds great. Enjoyed it.
Thank you.
Let us know how you enjoyed the show by giving us a like. And don't forget to subscribe to not miss the next episode. Got a question you would like for us to answer? Email us at info@getinvestorready.com. Thanks for watching.